Hello, my friends. Brett Patterson coming at you from the financial capital of the West, the land bountiful. Glad you're here today. We got the chairman.
It's good to be here.
You look small. You need to bring that chair up a little bit. I'm not
bigger
than. I'm not taller than you.
So I can, be right level
with the mic. That's good.
microphone.
And speaking of mics, Mr. Follet.
It was a good transition.
Mike.
The mic right there.
Yeah.
Speaking of the mics. Yeah.
Glad to have you from
Glad
the
to be
land
here.
down south to join us here in the land bountiful.
Yeah. Saratoga Springs.
Yep.
Yep.
Thanks for coming in today. It is March 17th of the year of our Lord 2026, St. Patrick's Day.
Oh, yeah.
I don't have any
Where's
green
your
on
green?
either. Did you know that 50% of my family heritage comes from Ireland?
Wow. Where's your green?
So you're kind of a disappointment.
I don't have
What's going on?
kind of a
Doesn't
green
even
at
know.
all. It's not a huge thing. In
got-
my life, it wasn't a big deal.
You got a lot of family pride there.
Yeah, I got a lot of redheads in my family, but not me.
Yeah.
But anyway, happy St. Patrick's Day.
Thank you.
Most important, though, you guys, tonight, 6 o'clock Mountain Standard Time. By the time people listen to this, this will be over. WBC Championship.
Which is
WBC.
what?
Well, if you ask
What sport
Spencer,
is it?
it's white blood cells. But
I thought it was World Boxing Championship.
come on, you guys
When
are
you bring it up, I think boxing.
baseball.
Baseball.
World
Baseball championship tonight.
Championship.
Nolan McLean for the United States of America. He's a prospect in the Mets organization. He's
He the
pitching
rookie?
for the U.S. He's the rook.
Wow.
He's pitching against Eduardo Rodriguez from Venezuela, who pitches for the Diamondbacks. I'm so excited. I forgot to wear my Aaron Judge USA jersey today.
How dare you?
St. Patrick's Day, I failed on that, but very excited. There's 69% probability the U.S., if you're a poly market guy, wins.
Standard deviation.
Yeah, there
You
go.
like this
there you
picture?
I would rather someone else be pitching because I'm a Yankee fan, but I'm going to cheer for the Mets guy tonight.
Okay.
Okay? We'll see. Judgy, greatest baseball player in all time. If you haven't been watching this, it's the greatest sports event every 3 years.
I watched Sunday Dominican Republic USA.
Wasn't that awesome?
That was fun.
Man, the crowd is bonkers in Miami.
That was amazing. That was fun. Yeah.
Yep. Should be fun. Should be fun. By the time this airs, we will know who wins. So go USA.
I mean, I'm not typically a big baseball watcher, but I've gotten into this. This is it's kind of cool.
It's good to have you.
Yeah.
Greatest sport around.
It is a great
It's
sport.
like chess.
And there's a lot of tie-ins. Buffett has a lot of tie-ins with baseball and
Oh,
investing.
that's why you like it. Okay, makes sense. That makes sense.
Yeah.
All right, my friends, there's a lot besides the WBC going on in this world of ours that is causing the market to be very volatile. We had a VIX, if you know what that is, spike above 30 or at 30, which means things are volatile. And why are they volatile? Because we have uncertainty in two areas mainly, and that is number one, war. We attacked Iran, and we check our political ideology when we walk into this building. So we will not talk about whether we like it or not. We will just talk about its impact on the market. Yeah. The second thing is private credit, which has gotten a lot of negative headlines. So we want to talk about both of those things today. But if you're keeping score at home, the NASDAQ fell from its highs 6.25%. So that's where we were a few days ago. We've rallied since then, but we were as low as 6.25%. The S&P 500, 4.75% was off of its high. And so, yeah, it's volatile. We haven't really seen a big impact. That's pretty normal movement. But let's talk war for a second. My question to you guys, what impact does war have on the stock market and on investors accomplishing their goals when war occurs? Thoughts?
Nothing.
What do you mean? Nothing.
Over time, nothing.
Okay.
The market, so it's interesting. You said the NASDAQ is down just over 6%?
A couple days ago, yeah.
So
6.25%.
So apparently, okay, just doing a little analysis here, looking
Okay.
at some previous conflicts, but
Okay.
the S&P 500 average drawdown initially after war begins is 6%.
Oh,
Interesting.
so we nailed it.
We're right at 6%.
We're right
Yeah.
there.
Right?
Huh.
And within 28 days, this blew my mind. According to, the wonders of the internet, 28 trading days, the market is back to the pre-conflict levels.
Within 28 days.
Yeah, within
So really, it's a month of volatility in the market, down 6% on average, which is what we've hit, and then we rally a month. The market kind of looks past it.
Yeah, that seems to be the case. And it kind of makes sense because when you just kind of take a look at the initial conflict, you get a lot of uncertainty. How's this going to affect global supply chains?
Yeah.
In this case, how are the energy markets going to be impacted, right, longer term? So there's a lot of uncertainty there. But it's interesting how that stuff seems to get worked out pretty quick. Then the market adjusts, settles in, and things kind of work their way back higher again. And it's interesting because would you say that this drawdown that we've had since the conflict beginning, has it been fairly orderly, right? The drawdown, there hasn't been a lot of market crashing.
There's been certain bear markets in certain underlyings, right? You've got some of these tech stocks that are down 20+%, not because of the war, because of AI concerns.
Other factors.
Yes.
Yeah.
So it's been orderly.
Yeah.
Yeah.
Kind of interesting. I felt like it has been too.
28 days after that. So in the short term, the volatility, we take advantage of the opportunities via options or buying companies that we want to buy. But really, you're saying, Mike, nothing to be concerned about from an investor trying to accomplish their financial goals and growing their portfolio.
Yeah. When
At
you
least-
think about
at least-
things over time.
Yeah, at least historically, that's been the case, right?
Yeah.
That's-
And it could be different this time around. We don't know.
I mean, one thing I don't love about this is we're spending about $1 billion a day, which just adds to our deficit, So I don't love that aspect of it. And I think there is an expectation, at least, we hear in Washington, that the war is, we're not expecting for this to be a 3-year war or a 5-year war. We're expecting maybe months, maybe just a few more weeks. We don't know, but
Let's hope not.
Let's hope.
Yeah.
No one loves war, right? But let's hope that this is over sooner than later.
So the opportunities short term, we've seen, we own a defense company, and that defense company's gone up, right? You see, depending upon the countries involved in the war, you'll see a spike in oil, which we've definitely seen, right? So there's some short term impacts that we try to trade around in the option side of our portfolio, but yeah, nothing long term, unless like if a nuke goes off, all bets are off, right?
Yeah.
That's where all these statistics go to the wayside. But barring something like that, it should maintain within some sort of plus or minus
balance.
It's average, yeah.
And hopefully we can get the oil start flowing again through the Straits of Hormuz, and there's about 20 million barrels a day that flow through that, which is about 20% of global production every day. We produce globally about 100 million barrels a day, and 20 million just coming out of Iraq, out of the Straits of Hormuz. So
Yeah.
So 90% of that, which goes to China,
right, yeah.
and a small percentage to the U.S. But
Well, it's not just China. You've got, for example, Japan. They're a massive consumer over there.
Yeah.
But what's interesting is I would say the big risk out of this, and feel free to disagree, but is the inflation situation,
Yeah.
global supply chains, and what kind of spillover you might have within that
Yeah.
regard. And the fact that, one thing that's been on investors' minds over the last couple of years is what shape are we in inflation? If this causes an inflation shock, that might be a larger concern. Interestingly enough, one of the things we focus on here is just full equities, right? We're very much an equity advisory service. And what's the number one hedge for inflation?
Yeah.
Over,
Equities.
a lifetime of investing. It's equities.
Yep.
So
Right.
it's kind of interesting that, although challenges could still be ahead, equities, not always, right? But equities tend to be over time a pretty good solution to some of those challenges.
I mean, you've seen that a little bit in the markets when we had oil rising up, over $100 a barrel. That was a kind of a shock to the market, and the markets have been pretty orderly, but on those days it's been a little unorderly,
Yeah.
right? On
Yeah.
those days, yeah. So, and that's because the inflation fears, I think.
Yeah, I think you're right.
So if you were talking to a client right now and they call worried about the war, what would you tell them, Chairman?
Well, I think what Mike said is spot on. I mean, ultimately, at the end of the day, the war will be over and the impact will be fairly minimal. We'll look back 3 months from now and probably not a huge impact. There's always a lot of noise in markets, a ton of noise, and I think this is noise. I mean, it's real. I'm not saying it's not real, and there's some, I want to stay out of the politics side of it, but there are real impacts globally on war and what's happening. But on financial markets, I mean, you think about it, you back it up and you say, okay, look at a company like Amazon. What effects does this war have on Amazon? Now, it might have some inflationary effects on their costs, and oil is in so many different products and things, but there's but it's on the margins, right? It's not going to change the business of
the
Amazon.
4 criteria for owning
Right.
Amazon.
Right. It doesn't change the argument there.
So relax. If you're worried about the war, from a portfolio perspective, from your investment side, we've got it covered. We're keeping our eye, obviously, on everything. Don't stress about that side. Now, if you're big into politics, you can take whatever side you want to be on and be passionate about it.
Right.
But from our standpoint, it's what you said, Mike. Equities rule.
There's signal and
which
noise.
we'll talk more about.
I mean, there's signal and noise, and this is not a signal. This is noise, and ultimately, we're looking for the signals on a business that, help give us good information, and I don't think, this war is going to change our thesis on any of our businesses.
That's a great way to put it. Signal, it's noise.
Right.
It is noise. Speaking of noise. Here's the other thing. If you've watched the financial news or read the Wall Street Journal or anything like that, there's a mess supposedly right now in the private credit space. Hey, it's been in the news quite a bit. People are predicting, and I mean, there's always bearish predictions out there that private credit is a 2008 crisis waiting to happen, which...
Well, how big is that market? I think
I don't see.
Didn't you look that up?
Yeah. Well, it's $3 trillion.
$3 trillion.
That's what the
$3 trillion market.
Private credit.
The stock market, U.S. stock market, not even global. U.S. stock market's $55 trillion. So to put that into perspective.
Yeah.
But okay, so let's back up a second here. Private credit. What is private credit? Number one, Brian, and then what's happening right now in it?
It's interesting. Private credit, I've been in this business for over 30 years, and private credit was never in my vocabulary probably for the last 20 years. It has been in the vocabulary the last, several years, but 20 years ago, I don't really remember even talking about that. But private credit is basically where institutions loan to businesses as opposed to, a banking organization like JP Morgan or Bank of America. And so it's just private institutions that loan money to businesses. That's all it is. It's just private lending. And the difference is back after the financial crisis, banks played a primary role in lending to these companies, but banks have kind of stepped back from that, and so there was a kind of a gap and a hole that needed to be filled, and that's where companies like Blackstone and Apollo and others, Blue Owl, I think, is it Blue Owl?
Blue Owl.
Blue Owl, which is in the news all the time, not for good reasons, but that stepped up and are now lenders in this space.
So you have a segment of companies that are kind of middle market, meaning they're not big, they're not small, they're kind of in the middle,
right.
These companies. And these companies can't go to a JP or to these big financial institutions and get loans. So they go to, because those guys want the big dogs. And so they'll go to these private lenders, the Blackstones of the world, and they'll get loans so that they can build their business.
Yeah, and J.P. Morgan doesn't want to deal with, like you said, these smaller businesses with probably less credit or more credit risk. J.P. Morgan just got out of that business. A lot of the big banks got out of that business where these are kind of high yield loans. A term you've heard is called junk bonds. Junk bonds. It's kind of in that category. They're lower credit risk, and banks just don't want that business anymore. And they're dealing with the big companies like Coca-Cola and Amazon and things like that. But there's a lot of smaller, mid-sized businesses out there that they can't go to a J.P. Morgan and get a loan, so they go to these, Apollo, they go to Blackstone, et cetera.
So Blackstone, I'm just going to use Blackstone as an example. No other reason, just to use it as an example, right? Blackstone will get dozens and dozens and dozens of these loans, and they'll package them into a fund. And then they'll contact people like us to sell this fund to clients, saying, hey, here's a high yield, right? Because it is the junk bond stuff. So here's a high yield. Here's a 10, 12% yield for this private credit fund. And what I have found is typically they're pitched to the kind of the more wealthy of clients. Mm-hmm. You have 10, 20, 30, 40 plus million, people like us, firms like not us, because we don't do this, but other firms, they'll pitch it to their high net worth clients saying, hey, you need this because you need an asset class for private credit, so jump in. You got to have this, right? It's not available to the public. This is special. And they package it real nice and pretty. And I won't tell you what happens when they open it, but we'll talk about that here in a second. So they got this pretty package. They pitch it to people with the note, just with the understanding, these are illiquid investments.
They are.
Right? Because it's debt. And it's a loan made out to a company. And so you can't sell it and buy it like that. So what's happening right now with private credit that is making the fearmongers of the world kind of sit on their mountaintop playing their trumpet bearish music?
I mean, this market these private investments are illiquid, and you got to know that when you go into it. And so you give up liquidity when you invest in something like that. Blackstone has one that's called BCRED, 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 and that's their private credit fund. Yeah. And they will redeem, I think, 5% per month, something like that.
Quarterly, isn't it?
Or maybe it's quarterly. It might be quarterly. But you think about it. It's a loan to a business. You loan money to XYZ company, and you can't get your money back.
You can't just call back the loan.
That money's invested into equipment, buildings, employees. You can't just go get your money back. So they're illiquid. We've
had some clients that have transferred their assets for us to manage, and we end up with some of these types of funds. It can take years to get out of it.
Well, when everybody's at wanting their money, which is right now, people are asking for redemptions, and it's called oversubscribed. You can't get your money out.
So what happens then in the fear right now that we're seeing in the market? There's a couple areas. But one is technology, right? These middle market companies that say are software companies or companies that AI is threatening to overtake, right? You don't need them anymore because you can vibe code something. And so the fear is that the default is going to happen on some of these loans. And so people are rushing for the exits and oversubscribing to the liquidity that they have quarterly, saying, I want out, because there's default risk in these loans. And so that's part of the fear. And we've seen some defaults.
Yeah.
Blue Owl has had some defaults. So it's freaking people out.
Yeah.
And regardless of what the fear is in the moment, whatever is causing that, if you want to get your money, you may not be able to get it.
Right.
That's the key, right?
That's the contract problem. You literally sign as you're signing the paperwork
exactly.
to own the product.
What are these? Usually about 5 to 7% can be redeemed from the month in a quarter.
Typically,
Which means if you put in a request to sell and get your money back, it might take, depending upon the condition of the fund and the amount of other redemptions that are coming in, it might take many quarters for you to get your money back.
It could take years.
Am I understanding that?
Years, yes.
Well, if everybody's wanting their, if you get more than 5%, they prorate it, So, okay, this guy gets 1%, this guy gets 1%.
Yeah.
I mean, it could take years, yeah.
So here's the problem. I'm going to go back to the packaging, right? These companies make, and look, not all private credit is bad. There could be some good funds
It just
out there.
is what it is.
But it's a packaged product to be sold. And as you don't know what's in that package. What are the loans? Where are they? What are the companies? What's under the hood, so to speak? You just don't know. And so in the case of Blue Owl, which has been hit and there's been defaults, you open up the package and who knows what's in there? You don't even know what you own in this private credit space. And so that's the risk, illiquidity, and what's under the hood? What's inside this package?
You had said earlier it's a black box. I mean, that's you don't really know what's, like you said, what's under the hood. And that's why, you need to, if you invest in something like this, you have to have a lot of trust and confidence in the underwriting of the financial institution you're putting your money with. Like if you're, for example, Blackstone or Apollo, you got to feel very confident that these guys are doing a good job underwriting good credit risks. And same thing at a financial institution. Buffett always says, if you don't know jewelry, you better know your jeweler.
Yeah.
And this is this same thing. If you don't know what's under the hood in a financial institution, you better know who's doing the underwriting, have a lot of confidence in them.
Yeah. Another thing, just to add to that.
Go for it.
What's generally happening to the interest rate environment right now? Generally. And I get we had a spike after the war started. But rates have been kind of generally going lower, right?
Yeah.
So interestingly enough, something that might be causing more redemptions to take place is the yield on these products tends to drop, because the way that yield works is kind of a variable yield. It's based on a SOFR rate, right? And so as SOFR rates change, the incentive to be invested in that product tends to change as well. So if rates generally come down, that could cause more people to want out, and then you run into that liquidity trap. So it is kind of an interesting thing in our environment. It might not be so favorable for those that want to get out, for sure, with rates in general dropping. So.
Yeah, good point. I feel like these products are products that are meant to be sold. Very rarely purchased. Some clients, it makes sense. But academia, if you're looking at academia and how most firms like ours work, they'll look at somebody and they'll say, you need 10% in private credit. Well, why? Because it's diversification. You have no idea what it even is. It's like an annuity. Annuities are meant to be sold, not purchased, most of the time.
Yeah.
Right? So, I don't know. Buyer beware. You've got to know what's under the hood.
Know what's under the hood
of the products that you own.
And
right.
you tend to hear about these products after they've already gone through a really kind of profitable cycle for that business, right? We've had a lot of technology expansion recently and rates kind of going up, right, over the last few years. That's been the cycle: business expansion, credit being deployed, and rates going higher. I think that's been a really good environment for these types of products.
Yep.
But now things are changing.
Things are changing.
It comes back to our number one rule, our first rule of investing: understand or know what you're investing in. Understand,
know
what
the
you're
product.
investing in. That's our number one rule. The first rule that we apply to our process. If you don't understand it, don't invest in it. So if you don't understand, private credit, then you probably shouldn't be investing in it.
If you invest in it, you've got to understand it's illiquid, and you better be looking. Let's throw private credit, let's private equity, venture, whatever it is. You better be looking for 18 to 24% returns to deal with the illiquidity. It should be double the market.
See, and that would terrify me. If you've got 18 to 20%, what does that mean? right? I mean, money's not free. Yield isn't free. The higher that yield is, the higher the risk is going to be.
Yeah.
It's the way business works.
But because of that lack of liquidity, you should demand higher.
You should.
Way higher.
And yeah.
So you better know.
Yep. Right. So here's the returns from some different asset classes. Okay. I've got stocks, private credit, real estate, corporate bonds, gold, government bonds. Okay. And there's two types of returns. There's a nominal return, but then there's a real return. Do we want to focus on real return? Does that work?
Sure.
Yeah.
So real return is just factoring in inflation. What's the inflation adjusted return of these different asset classes? Okay. S&P 500, top of the list since 1945, by the way, post World War II. 7% annualized return.
Real return?
Real return.
So that's after inflation.
After inflation. It's the highest growth. It has a lot of volatility, as we know, but 7% real return. Private credit. We just said if you're going to be in an illiquid investment, you better have double, right? Double-ish the return. It better be better, which is illiquid, by the way, just as a reminder, 6%. 6% real return. So less than the stock market with illiquidity. Real estate, 3% real return. Okay. That depends on where you're invested and all that kind of stuff.
And the time that you
invest. And the time. Well, everything's the time. I'm just looking at annualized. But some cities might be better than that, but 3% real estate.
Yeah. I'm not surprised by that.
Neither am I.
No.
I want to scream this from the mountaintops is what I want to do. Right? But why do people like real estate? Because it's not priced daily. They don't see the volatility.
And
yeah, that's true.
And that they can drive by and look at it.
Oh, that's
tangible.
fun.
Yeah.
I just sold a pile of dirt. I went by and looked at it in 4 years twice. It was real pretty to look at.
Did you have an agent helping you with that transaction?
Yeah.
What do they charge usually?
Yeah.
Like 6%?
I mean, you're paying 6% for both sides.
Just to
illiquidity.
Get in or out?
Yeah.
6%.
And a lot of paperwork.
Well, that soaks up the 3% annualized pretty quick, doesn't it?
And I love my agent. But, yeah, corporate bonds, okay, 2.5% real return. You've got gold, which everybody's talking about gold right now because they caught a trend.
Yeah.
But wait till you hear this real return, 1.5%. Annualized real return after inflation.
Gold's been on a tear
since
lately.
1945.
But, I mean, gold was flat for...
Nothing for 20 years and then double.
And we'll go nothing for 20 years after this run, right? Like, that's just how it works. Government bonds, 1%. So government bonds, almost as good as gold. So how is gold an inflation hedge, Mike? At 1.5% annualized return.
I just know that's what they say on the podcast. So
that's what they say on every right-wing podcast. Buy gold. Because it's fear.
Yeah, it is.
It's just a fear investment.
It's the lizard brain for sure.
Yeah. I don't know what lizard brain is, but that sounds...
It's the fear.
Okay, that's fear.
And it's also a little bit of recency bias as well. You know, when something's doing very well, something's, automatically you think, oh, you better jump in there, right? Or something's doing poorly, just the opposite, right?
So if I'm going to draw 4% from my investment accounts to survive in retirement, there's real estate, no. Private credit, yes. I mean, that's 6%, right? So you're still +2. And stocks. Those are the only asset classes that you can have in your portfolio that keep pace with inflation and you can actually draw and have an income in retirement. Those two investments.
Yeah.
Okay. And again, we've already talked about private credit, so take that for what you want. But let's talk stocks for a minute. The highest growth, the highest volatility. I'm going to read you a quote from one of my favorite authors. He's my man crush. Yours is Buffett. I like Nick Murray.
NM.
Yep. Brother Nick Murray. He says this. He says, I own mainstream equities, stocks, for 2 reasons. Second to love, the most powerful force on earth is human ingenuity. And 2, equities are the only asset class that fully captures human ingenuity. What does that even mean? What is human ingenuity? And think of America. Like, what's the ingenuity of America? What's happening right now? How do we explain this to people? What does that mean?
You have a person has a dream. Whether it's Mark Zuckerberg, in his dorm room at Harvard, or Jeff Bezos quitting a great job, a hedge fund job in New York, and driving to Seattle. He and his wife driving to Seattle with an idea to capture the internet back 25 years ago. He had a dream, and I would say that Jeff Bezos probably had some ingenuity, on this idea. And of course, now you look at Amazon today. It's captured a lot of ingenuity and created a lot of wealth and employed a lot of people and
Has Amazon changed since its first?
I mean, it's changed. The early days, it was a bookstore. They were selling books.
Yeah.
And you look at now, Amazon sells everything.
Books and everything else.
Everything else. I mean, tell me something they don't sell.
So what you're saying, and let's look at ingenuity for a minute, is people's ability to adjust and change and dream and build new things,
solve problems,
and
and get paid for it,
and make money for shareholders as well, right?
Yeah.
Everyone can take advantage.
Participate.
Of this.
Yeah.
What's happening right now in the market? I mean, we're seeing an AI explosion. How has AI and some of these investments that our clients in captured human ingenuity?
I mean, Google and some of the engineers at Google have been talking about artificial intelligence for the last 10, 15 years. I mean, I would listen to Google calls, conference calls, and they talk about AI. And it just went in one ear and out the other. I'm like, AI, okay, artificial intelligence. I didn't really understand really what it meant. But they've been talking about it for 10 years, and that's human ingenuity. And and then ChatGPT kind of blew the doors down a couple of years ago, and took the world by surprise. Like, what is it? What are they doing?
A company that didn't exist.
Oh, that's what AI is.
5 years, it's $100 billion.
This is what AI is.
Having a conversation with this thing.
Right.
Yeah, I'm gonna mention one person's name, okay? And Mike, tell me about ingenuity with this person, Elon Musk.
Yeah, I mean, he invents stuff, or he comes up with ideas, sells the idea really well, has folks work for him and
team.
invent stuff. Yeah.
Like what?
Well, it depends on what you're talking about. I mean, the guy digs holes. He goes to outer space. He shoots hot rods into the air or into spaceships that are currently orbiting the Earth.
Flamethrowers.
Yeah,
The Neuralink. Like, nobody's talking about the Neuralink. You put a computer chip in your head and you can see color.
The mark of the beast.
Yeah, like, I mean, that's ingenuity. So how do equities take advantage of this human ingenuity that's changing month by month? How do equities take advantage of that?
They give these inventors the capital to go ahead and make their stuff and build their business and bring it to market. Is that where you're going with this?
Yeah,
or is that where
that's exactly right. And they issue shares of their company that we can participate in that upside.
Yeah,
like,
buy it and own a piece of the business. That's
what it is. Look what certain companies have done. These are not recommendations, but Google, NVIDIA, Facebook. Look at
somebody had a dream. Jensen Huang. In fact, they were at a pancake house. He and his buddies, and that's where they got this idea on NVIDIA. They had some ideas about on GPUs and gaming, and I think it was a pancake house or house of. Anyway, it's
Denny's.
No, that wasn't Denny's. I think
Waffle House.
I think it was a Waffle House. That's where the idea of NVIDIA came from. Jensen Huang.
It's unbelievable.
Really?
3 other guys. They were at a Waffle House and they had this idea and they says, "Let's do it."
His story was on Joe Rogan. He was on Joe Rogan, and unbelievable interview as to that story. Right, the dude was cleaning toilets, and now he's taken advantage of this country's great resources and has been able to grow into this amazing business with ingenuity.
This idea that we're talking about, though, is really one of the advantages that the United States of America has over almost anywhere in the world, and that is we have capital. We have capital markets that will fund ideas like a Jensen Huang with a low probability of success, but investors are willing to give this company a chance. You know, and in the case of NVIDIA, that was a pretty good investment.
So which is 100% true, and you don't see that type of risk taking in Europe.
It doesn't happen. It doesn't happen, and that's
how we were hardwired here.
Well, and you look at all the big success companies in the world right now. Most of them are U.S. companies, because we will fund, investors will fund these ideas, even though they're low probability, ideas that, may or may not turn out, in the case of Google or Amazon, they did, But.
Brian, in a minute, I'm going to have you sing the national anthem.
I know.
Okay? But here's the question. We're talking about equities. Okay, I'm looking at other asset classes, real estate, corporate bonds, gold, government bonds. Why am I saying equities, and why is it equities capture ingenuity versus corporate bonds? Like, why is that the case?
Well, I think in the case of bonds, one of the challenges with bonds is you just keeping up with inflation. I mean, you talked about it, and with equities, for example, I have this chart here. Over the last 30 years, $1 invested in equities is over 760, percent.
Zoom in.
789%.
789%.
Versus your dollar sitting in a bank, in a cash account, the purchasing power is down about 52%.
That's
so half the value.
The greatest inflation hedge is equities. But if I'm a bondholder, right? The company issues debt, and I buy the debt, and I'm paid a coupon, right? I'm paid a yield. What do the companies usually do with that debt?
Well, I mean, they could.
Why do they issue it?
They could build a new plant. They could hire employees. There's all kinds of reasons why they might.
I'll make a general statement.
Okay.
To fund the ingenuity that they have.
That's.
So why would I want to be the funder of the ingenuity that they have rather than taking advantage of the growth of that ingenuity?
Participating in the growth.
Participating. That's a great way to put it.
Yeah.
Well, and if you just think about the structure of the product, right? A bond, you've got these fixed terms for payback, right?
It's a contract.
Right. When you're dealing with an equity, it's an ownership stake, right? You are literally taking a piece of that business and investing in it. And so all the future growth, in theory, you can participate in that, right? You're not contracted to be paid back, $10 million or whatever it is at X rate over the next 30 years or in the next 5 years. No, you've got ownership in the business for as long as that business is alive. And if that business grows, you participate in that.
I mean, your capital is at risk. When you own equities, there's no guarantee. There never is a guarantee. There's volatility. Some businesses don't make it. I mean, all the businesses that competed with Amazon. I mean, there's hundreds of businesses that didn't make it. But and with fixed income, it's a contract, so there's a little bit more certainty. But you don't participate in the ingenuity of capitalism by owning fixed income or owning a bond or owning a contract. And the only way to do that is to own equities.
Which, second only to love, he's saying, is the most powerful force on earth. Human ingenuity. That's awesome. Why do we wake up in the morning, right? But Mike, what you said needs to be printed and read by every equity holder every day. You own a stake in the company.
Yeah.
It's not a ticker symbol.
No, yeah.
You have the right to future earnings because you own part of the company
And
the future of the ingenuity of whoever's running that company.
And I think that's what a lot of investors struggle with, honestly. They feel maybe overwhelmed by having to study, which stock is going to be, what's the best business to buy if I'm going to make this longer term investment. That's hard to kind of go through all these stocks that are out there and try to figure out which ones have the best prospects over time, which ones have the best management team. That's what's great about having a Brian, right? Everybody should have their own Brian because he figures that stuff out and does a lot of analysis to kind of take away that.
Well, I mean, it's a process, right? I mean, that's what it is. It's a process, and we have a process, and we stick to it, and it works. It's been proven, and that's
Yep. Yeah. Which don't sell yourself short here, brother. You're part of that process.
Yeah.
But you think of it, and I remember one of the first times we spoke, right, when I came on board, I felt like anyway, you were trying to convince me, no, you got to think about these are businesses we're buying. We need to analyze these from a business point of view. And I'm like, well, let's just trade them. Let's look for volatility opportunities, which, I'll always be endeared to that side of the business. But if you're going to take a stake, an equity stake, it makes sense to approach it the way you're.
Whether you own one share or you own 100% of the company, I mean, you shouldn't look at, and the way I look at it is you shouldn't look at it any differently. I mean, you might as well be, you think when you're buying a business, you're buying a stock, you should think of it as if you're buying the whole company. You own 100% of it. And
equities are the only asset class that fully captures human ingenuity. Amen, brothers.
Yeah.
I like it.
Yeah.
And I'm proud to be. I won't sing. Nobody wants to hear me sing. But with that, it's a volatile market. That creates opportunities. A lot going on right now. Stay the course. Find those opportunities that will enable you to take advantage of human ingenuity in this great country of ours. With that, my friends, good conversation.
Yeah, it's good. Thanks, guys.
Until next time. Bye now.
Bye.